It is official. 2022 has been the worst year for the S&P 500 in more than a decade. The S&P 500 index is down around 18% since the start of the year, while the Dow Jones Industrial Average has lost around 9%. With the economy in the territory of uncertainty and the Fed signaling that more rate hikes are coming, here's what market experts say to expect in the year to come. Number 1. No earnings downturn. Since companies produce earnings and sales in nominal terms, estimates of earnings for the S&P 500 will not be nearly as much as some are expecting. It will allow companies to take care of margins just enough to keep earnings at par with the levels of 2022, which means that there wouldn't be an earnings recession in 2023. No growth either, and around $230 in earnings for the S&P 500 versus the estimated growth rate of near 8% at the end of 2022. Number 2. An environment for recession. A close inflation rate in the 5 to 6% likely means that nominal GDP growth will decline, but we won't be seeing a recession in 2023. It is more likely to continue to a stagflationary environment that would result in nearly 0% real growth rate. Number 3. Crypto will carry on to be weak. It took a long time than it did with most other investments that were speculative. But cryptocurrencies seem to have dropped out of interest with investors in recent months. And the collapse of FTX certainly did not help gain the public's confidence. From the statistics, we could guess the leading cryptocurrencies would be more probable to have another rough year in 2023. Number 4. Key rates to rise above 6%. With inflation continuing in the same 5 to 6% range and the economy keeping up together, the Fed will be pressured to increase the rates above the 5.2% level, more than that mentioned at the December FOMC meeting. It will most likely end up in an overnight climb above 6%. Number 5. The S&P 500 will face hardship in 2023. With the Fed likely to increase rates more than expected, inflation staying constant and earnings in doubt, the S&P 500 will fall again for a second consecutive year. The index is likely to see a peak fear capitulation type of moment when it trades down to around 12 to 14 times earnings. At 14 times $230 in earnings, which equals 2022, the S&P 500 is worth only $3,100, and at 14 times earnings, just $2,800. But given how the market likes to trade to extremes, it may overshoot to the downside, trading below 3,200 and filling a gap from May 2020 at 2,817, only to rebound and complete the year with around 3,200. Number 6. Finance stocks surprise to the upside. In 2023, the shares of financial companies are expected to increase. Banks earn income from net interest margin or NIM, and increasing rates tend to rise the spread. For every 1% that rates increases, Schwab will earn around 6.3% more in NIMs. At online bank startup SoFi Technologies, each extra NIM dollar raises operating income by $2.33 because of the fintech's relatively high fixed cost. That's good news for investors in firms like SoFi. The company has little direct exposure to mortgages and a stock price that now borders on its liquidation value. It would not be an easy ride. But for investors with a higher risk appetite, finance stocks like SoFi and Charles Schwab will surprise to the upside in 2023. Number 7. Investors wait too long to buy. Finally, stocks typically bottom out around 2 months before the end of rate hike cycles, as per the data going back to the 1980s. That pattern indicates that markets will bottom out in Q4 2022 since rates will highly rise in early 2023. Many retail investors, however, will miss jumping back in. That means a lot of investors will miss out on deals that are once in a decade. 43 US-listed companies now trade with negative enterprise values in spite of having positive free cash flow. 2023 will be a great year for many of these companies, and many investors stand to miss out. Given the predictions, what can you as an investor do and achieve profit from this? Number 8. Focus your attention on defensive stocks. There is a high possibility that 2023 will be just as unpredictable and turbulent as 2022 was. In this scenario, investors should concentrate on defensive stocks, which are those that have the potential to give some degree of stability in situations where uncertainty or recession over the macroeconomic environment takes place. When the performance of the company is largely constant throughout time, irrespective of the economic status as a whole, that stock of the company is said to be defensive. Due to the fact that they aren't affected by the economic cycle, these stocks are also known as non-cyclical stocks. As a matter of fact, defensive firms are not likely to be much impacted by the contraction and expansion stages of the conventional market and business cycle. This is due to the fact that the services or goods that defensive companies provide are often necessary to the lives of their customers. Some examples include consumables like drinks and food, utilities like electricity and gas, medical supplies, as well as services like water purification and garbage collection. In addition, despite having a higher stock price, defensive companies often maintain a consistent dividend payment, which provides a passive income to investors in both bearish and bullish markets. Because they are less risky and cheaper, these stocks are usually an option that is preferred for less experienced investors who are not as familiar with working in the stock market or for investors having a risk-averse profile. Number 9. Closely monitor the development of growth stocks. As a matter of fact, that defensive stocks are a preferred choice to be included in portfolios in order to maintain stability. It is necessary to monitor the development of growth companies. As a general rule, cyclical stocks or growth, which are regarded to have more risk than defensive stocks, provide more attractive investing and trading possibilities than the latter. This is because companies that focus on growth are more likely to suffer losses during times of uncertainty and periods of rising interest rates. This is because the growth stocks are equities that have growth rates much higher than the average growth rate of the market. This suggests that a growth stock is building at a faster rate than the average market stock and is subsequently earning profits at a higher rate. Or, at least investors are expecting higher profits, which allows investors to benefit from a higher increase in the stock price. When markets are rising up and the economy is doing well, growth stocks will typically do really well in terms of performance. In point of fact, they provide more profitable and exciting opportunities than defensive stocks, which have a tendency to act less well when the market and economic circumstances are strong. Growth stocks are also more likely to become more volatile than defensive stocks. However, because of the various uncertainties that withhold the outlook for economic growth as a result of the conflict in Ukraine, the gradual reopening of China, inflation, and the tightening of monetary conditions around the world, markets have been stranded away from growth stocks, which are assumed to be riskier investments. This indicates that the valorization of some growth stocks may have reached lower levels, or at least levels you would think are more probable to buy them at. And you may choose to add these assets to your portfolio as an option for a long-term investment. Try to concentrate on popular and well-known companies whose services or products will be attractive again once people have more money to spend on less necessary items like luxury, for instance. Number 10. Prioritize businesses who have a strong pricing power. If you think that inflation will be an issue in the medium to long term, you should consider investing in businesses that have high pricing power. This means businesses that are able to raise their prices without seeing a significant decrease in demand for their services or goods. Such companies are often a nice bet when trying to look for investment vehicles against inflation risk. There are most industries that have high demand, such as the pharmaceutical industry, electronics industry, aviation industry, restaurant industry, food industry, and textile industry. However, it is also essential to take into consideration the development of the industry, the elasticity of the demand and its profitability, as well as changes in the cost of the raw materials or other inputs used in the production of these services and goods to come to a decision for the best companies to invest in. Lastly, consider financial stocks. If you think that interest rates are going to be as high as they are now for a while, or if you think they will rise in the countries you are investing in, you can consider buying financial stocks that will give you an advantage over high interest rates through higher income or interest, like brokerage firms, banks, and insurance companies, among others. However, it is always essential to take into consideration the general context, as decreasing growth prospects might strongly affect investment and spending behavior, which can substantially lower the credit activity, which will in turn affect the profit margin of these companies. With that, we have come to the end of this video. Do you agree with these predictions? Do let us know your thoughts in the comments down below. If you like this video, make sure to like, share, and subscribe. For more videos like this, click on the links you see on the screen. We will surely come back again with more informative content. Until then, stay safe and invest.